Well, welcome all of you. For those of you that don't know, my name is Christina Rouse. I'm the president of the Rhode Island Commercial and Appraisal Board of Realtors. This is our first expert forum of 2023. It's a series that we run almost monthly, and it is all via Zoom, and we have special speakers all the time. And today we have Mike from Walport Insurance, which you'll get more of a bio from him, from Steve Kirby, in a bit. But did want to shout out to our sponsors, which is Cornerstone Commercial Capital, Sage Environmental, Sarah Regan and Thayer LLP, and Alpha Electrical Contractors Inc. I do want to note that we are always looking for sponsorships for the Rhode Island Commercial and Appraisal Board, whether it's these expert forum series. We do have some in-person events as well, like our socials, as well as our commercial day that we host at the end of the year. So a lot of different opportunities for sponsorships and different levels there, a lot of exposure for your money. And then also, just as a reminder too, our next expert forum series is going to be happening on February 8th, and it's the state of the commercial real estate in Rhode Island. So be sure to keep your eye out for that. That's always interesting. And without further ado, I'll kick it over to Steve Kirby, who is the Rhode Island Commercial and Appraisal Board Treasurer.
All right, thanks, Christine. I have the pleasure of introducing my friend, Michael Swistak. He's a senior account executive with Walport Insurance. He is also the head guy of the Jamestown Planning Commission. He's a longtime Jamestown resident. Normally, I talk a lot about who our guest is, who our speaker is, but in Mike's case, I'm going to talk about what he is. First of all, Mike is my friend. We've known each other for 35 years, since we used to play rugby together. But more importantly, he is our go-to insurance guy. If we have any situation, if it's a tenant needing liability insurance, I literally can be with a client and I'll literally hand them the phone. Mike will take care of it on the spot. If we have questions about things, he knows the answers. And if he doesn't, he gets back to us almost immediately. He's got a wide range of knowledge, all in the commercial world, as well as, the normal things that most other insurance professionals do. But Mike just gets it. When we have questions about flood insurance, we aren't going to get the standard answer of, yeah, it's in a floodplain or not. He's going to tell us the 20 things to think about. So I can't thank him enough for spending the time with us today. And I can't encourage you all enough to reach out to Mike, for help, for business transactions. And with that, Mike, take it away.
Steve, thank you. You said a high bar. I hope I give you a few things today to some new ideas and a couple of takeaways that you can use on a daily basis. So our topic is changes and trends in commercial insurance, and the whole goal is from the real estate and to get you thinking about what to talk to your clients on the front end when you're starting a new transaction, whether you're representing buyer or seller. So before I dive in here to the meat of the presentation, Steve, thank you. Jack, thank you, Christina, for having me today. Thanks for the opportunity. So I'm going to share my screen off and on. If you have questions along the way, raise your hand, send Steve a chat message if you want to interject with a question, and we can make this interactive with a smaller group. That should be effective. So again, here, the first screen, this is here's my contact information, email address, phone number. As Steve indicated, I'm open to phone calls from anybody from your organization. If you've got a special problem, something that's unique, something that you're unsure of, feel free to give me a call, whether it's just
Mike,
a question or
the
whether
screen's not showing, Mike, just to interrupt you.
How's that?
No,
It's not the right screen. It's showing the Zoom.
Okay, so so just a front screen there. There's my name, email address, phone number. Again, invitation's open. If you ever have a question, as a member of the organization, you can call me anytime with a what if, or if you have a problem that needs solving. So just to set the table, of course, you know, for any new transaction, there's at least 7 people who have to interact at some point in time to get you from offer to close. You know, that's the real estate pros, the bankers, the attorneys, people on my end, insurance agents, and you know, you can't get to the finish line without an insurance binder in almost all cases. Nor would you want to. And we're all of us are exposed to our demanding clients and customers who all want the best deal. And by that, I mean, they want if they're the sellers, they want the absolute top selling price. If they're the buyer, they want the cheapest price possible. If they're buying insurance, it's got to be the lowest price possible. Same thing for the, you know, the attorney's fees, mortgage rates, and on. So we're all under this pressure to deliver at the lowest cost possible. And from your end, as you start to talk to your clients, you know, one thing to impress upon them is that insurance is a forever cost. It's never going to go away. For your ownership of a piece of property, that's an every year cost like taxes. And the last 25 years, insurance rates have never gone backwards. Insurance rates increase annually without fail. Some years you're lucky, it's just a couple of percentage points, but in this day and age, and what we're going to see here in the next 12, 18, 24 months, we're in what they call a hard market, where you may, people who own real estate are going to see increases of 5-10% or greater, depending on location and what type of risk it is. So it's something to take seriously. It's something to tell your clients not to ignore, not to wait to the last minute, do some homework up front, so they're not frustrated or disappointed in terms of what their expectations are in terms of coverage and price. So we're in this hard market, prices on the rise. What's driving it? Well, one of the 2 primary factors is weather, climate change. And whether you're a denier or a believer, the insurance industry are believers, and they're looking out 10 years, 15 years, 20 years at where we're headed in regards to climate change, and they're reacting accordingly. Just a couple of fun facts. Globally, 2022, it was $120 billion worth of insured losses across the globe. Most of the biggest ones happened in the United States. Second largest were wildfires in Australia, flooding in Pakistan. But just to give you an idea here, across the United States, there were 18 separate weather events that all exceeded $1 billion in insured losses. So there's your map across the country. Hurricane Ian in Florida, Naples, Fort Myers was by far the largest disaster for 2022. Count today on losses for Hurricane Ian were $60 billion, and they project that's going to cap out at about 115 billion. So think for a minute that all the insurance companies have one big insurance bank of money that's ready to write checks and pay claims. And just imagine that if you suck 120 billion dollars out of that bank account, it's got to fill up again. Well, that's all the premium we pay. The 18 $1 billion events is pretty standard. We've hit 18 $1 billion events over the last 5 years consecutively. So insurance companies are quite concerned about where we're headed. And on top of regular inflation, your regular inflationary factors for labor and materials, the COVID disruption added about 17% on top of material costs, whether that's lumber, roofing, siding, copper wire for electricity, plumbing materials. So if your customers are seeing 10, 12, 15% increases on their insurance renewals, well, that's why. COVID really startled the insurance industry. They weren't prepared for it. So rather than take increase in rates slowly, 2%, 5%, something reasonable, insurance companies in some cases have been forced to do double-digit increases. On top of, we're talking here about property and damage to property. The other thing that's happening across the industry is an impact on the liability claim. If you get sued for instance, a slip and fall injury, what's happening is we're having this phenomenon called, it's referred to as social inflation. So social inflation is the increase in awards by juries for lawsuits. So if you think back 20, 25 years ago, the standard for insurance was maybe $500,000 for small business or an apartment house, apartment complex. Today, the standard is $1 million, and that may not even be enough, because what we're seeing is more and more what they call nuclear verdicts or nuclear awards of 10 million or more for injuries. So this social inflation is driving the liability cost on top of this double-digit property insurance increases. So here's let's take a pause for a moment. Anybody with questions or? You're muted, Steve. Steve, you're muted.
I don't know if you heard that. Can the state or federal government regulate what the insurance companies can charge?
Absolutely, Steve. Great question. So insurance rates are regulated state by state. So there are 50 insurance departments across the country. And for instance, in Rhode Island, we have Rhode Island Department of Business Regulation, the insurance division. And there are two types of companies doing business in Rhode Island. There are those that they're called admitted companies. So those rates are regulated. If an insurance company wants to raise rates, they have to demonstrate a need based on actual results. Then there are companies that are non-admitted, and they can, there's virtually no control. They can raise rates as high as they want, whenever they want. So it depends on who you're doing business with. If you're an admitted company, the process to getting your rates approved, it is a process. You've got to be 6 or 12 months out. So rate changes happen more methodically than the non-admitted company. An example of a non-admitted company would be Lloyd's of London.
So would you recommend that our clients who own buildings, that they go to someone like you and get an annual review of what their policies are?
Yeah, I think you've got to insist on that. And I think, people in the insurance business tend to, the insider scoop here is people like me, agents, We get distracted by the new customer. We get distracted by the people who have an immediate problem, and the people whose business is more routine, with minimal rate increase, minimal changes, tend to come last in the pecking order of the day of the calls you've got to return. So, but for the insurance buyer, they should insist on a face-to-face phone conversation with their agents every year.
Okay.
Yeah, good question, Steve.
Anybody else have a question on this section? Okay.
If you don't have a mortgage on a property, but you're more concerned about liability than you are the building burning down, can you just get liability insurance, or do you have to have, a fire policy as well?
You're mortgage free. You're on your own. Nobody's going to set the rules, right? It's typically the bank that's going to force you to have insurance. There isn't a bank who wouldn't force you to have insurance if they had a stake in your property. But yeah, mortgage free, Paul. You're free to do whatever you want. You can go uninsured or self-insured, as they say.
Yeah. I have a property in a flood zone, and the flood insurance was so high, but I didn't have a mortgage, so I don't have flood insurance. For about, I've owned it about 7 or 8 years, and so far, knock on wood, I've been lucky.
Yeah, and there are people all across the country. In fact, one of the big problems with Hurricane Ian in Fort Myers is that there were so many people like you who own property in Florida. Flood insurance was a real burden for them, and the day after the storm, they learned the hard way that sometimes it's not good to be self-insured, especially if you live in Fort Myers, Florida.
Thank you.
So the next thing that's driving rates is the insurance industry is finding out, or has recently come to the conclusion, and a lot of this is in the light of the COVID increases, is that of all the commercial properties across the country, about 40% of them are probably underinsured. So that could be something minor, like you've got a building that should be insured for 1.1 million, and you've only got $1 million of coverage. So the insurance industry is saying if we've got 40% of our properties that are underinsured, there's a lot of money being left on the table. And insurance, whether it's commercial or residential, it doesn't work unless the actuarial models don't work unless everybody is insured to the replacement cost. That's what the whole system is built on. So if people are underinsured, they're not paying their fair share to prop up the insurance bank, if you will, to pay claims. So, and you'll see, there are many policies. A good example is residential policies, homeowners policies. They have an inflation guard built in. So the coverage bumps up every year, anywhere from 2%, 4%, 8%. But a lot of commercial policies don't have that inflation factor. So if you don't pay attention to inflationary factors, you don't increase your building, you can become 5, 8, 10, 15% uninsured in just over a matter of 3 or 4 years. So what insurance companies are doing now to combat that is they'll go out, they'll inspect the property, pay for an inspection, they'll run a new estimate, and then they'll come back and basically force you to increase your insurance. The other good thing to know is that built into commercial insurance policies many times is a penalty if you underinsure. Now that penalty only shows up if you have a total loss. But if you're less than either 90% or 80% of what the replacement cost really is, you can wind up with a pretty significant penalty at time of claim.
How does
Um,
that work with these escalating construction prices?
Same thing, you know, with these COVID increases of somewhere 15 to 17%, all of a sudden in a short span of time, 18 months, properties today are 15% underinsured. Ordinance and law, sometimes called ordinance or law. So, you know, in New England, we've got the oldest building stock in the country. Probably average age of our buildings here in Rhode Island could be easily 100 years old. Think about the industrial buildings across Pawtucket, Providence, Smithfield, that area. Lots of buildings built in 1920, 1900s, mill buildings. Well, many of those buildings, if they're going to be rehabbed or rebuilt after a claim, are going to face requirements to be upgraded to bring them into compliance with new building code, or if they're being renovated for a new use. So insurance policies, if you have a replacement cost policy, will pay you to put back what you have there today. So what was ever there the day before the fire, the day before the hurricane, the insurance companies will put that back and pay for it. But what many policies don't do is provide enough coverage to cover the improvements that are required by zoning code updates. So let's say you've got a narrow stairway in an older building. That stairway is 3 feet wide. It now needs to be 4 feet wide. Or if you've got a public access building and it needs handicap improvements. If you don't have enough ordinance or law coverage, you're going to wind up paying out of pocket for those improvements if you've got a significant claim, and where the zoning enforcement officer or the building inspector is on site approving your permits to rebuild. That goes to residential property as well, whether it's multifamily, single family. Particularly, there have been a lot of changes about window sizes, stairway, doorway. A lot of the old houses built in the 20s, 30s, and 40s are all out of code. Business interruption also can be referred to as loss of rental income if you've got rental property, if you're a landlord. So we're talking about underinsurance here. Those numbers need to be looked at because in many cases, on many policies, they're understated, especially loss of rents. If you have a significant fire, you could probably expect it could be almost a year before you can get your building occupied again, if the fire is serious enough, even a serious enough internal water damage claim or windstorm. So if you're going to lose a year of rent, you want to make sure you have business interruption or loss of rental income coverage equal to a year of rents minimal. And business interruption generally pays for net profits or continuing expenses or the monthly rental, equivalent of a monthly rental.
How does that work for owner-occupied properties?
Occupied, so that would be, so if it's owner occupied, you're running some kind of business, whether it's an office exposure or retail, it would be net profit and continuing expenses, which can be payroll, which could be your largest expense. Could be interest on loans, electricity,
Was
taxes.
all that a huge deal during COVID?
Yeah, not to digress, but certainly one of the biggest problems with COVID were with retail and restaurants shut down. Insurance policies maintained that the COVID virus did not constitute physical damage to a building. So all of the COVID claims, COVID-related claims for business interruption were denied. Now, those have gone to courts all over the country. There have only been just a couple that were actually approved by the courts. And the reason they were approved by the courts is because they were using non-standard insurance policies that seemed to be written vaguely enough to allow for the claim to be paid. But across the board, all of our restaurants I don't think anybody's prevailed in Rhode Island. Across the board, all of our restaurants and retail were not compensated for any loss of business due to the COVID virus. Now that, just to give you a little history, that all started, believe it or not, with AIDS, the AIDS virus. When AIDS first happened, there weren't any viral exclusions on insurance policies. But within 6 months after that virus presented itself, insurance companies scrambled to rewrite the forms because AIDS was a huge unknown. Science and medicine weren't too far advanced. They weren't sure. They were very frightened about how that virus is going to spread. And then it popped up again with the H1N1 bird flu virus, which kind of happened and petered out. But by that time, the insurance industry had built-in exclusions because the insurance industry couldn't wrap their arms around how big those claims could be. Paying for the COVID virus could have essentially bankrupted the insurance industry. Great question, Steve. Any question? Well, let's go on to the next one. The other thing that's kind of driving rates here a bit is deferred maintenance, and I think this really is something people in the real estate end need to counsel their clients about, whether you're on the buyer or seller side. Insurance companies are looking very carefully at buildings that have not been maintained or well kept over the years. So if you've got somebody's coming in with a new application, insurance underwriters want to know how old is the roof? When was the last time the plumbing was updated? Heating system, is it adequately alarmed? What's the sprinkler system condition? What's the fire protection if you've got Ansel systems in restaurants? And if there's been deferred maintenance, one is it's going to be much harder to find insurance and the rates are going to be higher. And there's likely to be exclusions and limitations on what kind of coverage you're going to get on your policy. Insurance companies are now going out to inspect properties on a maybe 3-year, 4-year, 5-year basis. And if they're finding deteriorated conditions, they will send a mandatory inspection notice with a recommendation that says, make this correction within 30 days or 60 days, or we'll cancel, or we'll non-renew the policy. So the insurance companies are being more proactive about who they keep on the books or who they will underwrite right out of the gate.
Is it true that properties now almost have like an insurance credit score? And I've always wondered about that. And is that something, if that's true, is that something we should be investigating, before our clients buy something?
Some companies will use a credit score component when going through the underwriting process. So the insurance application does ask right on paper about prior bankruptcy or judgments, tax liens, lawsuits. But insurance companies will run a soft score in the background, and so they'll check D&B, Dun & Bradstreet status. Some will run soft credit scores on owners, and they'll do that without social security numbers. And if a potential insured has sketchy or horrible credit, they'll walk away and they won't offer coverage.
Actually, I was asking, put it a different way. Does the property itself have some kind of score? So, if a property had a fire in 1968 and then had a flood in 1976, does it have a XYZ score?
That's true on the residential side more than the commercial side.
Okay.
Residential insurance companies participate in what they call a CLUE report, comprehensive loss underwriting extract. So, Steve, if you had a fire at your house, claim was paid, your insurance company will likely report that to the CLUE system. So after your second fire, and you get canceled and you go to find new insurance, if you choose not to disclose that you've had 2 fires, they're probably going to know anyway, because it's like a motor vehicle report. Like you've had accidents, it becomes basically not public record, but a shared record amongst the insurance industry.
Is that something us as agents can get a hold of to counsel our clients that, yeah, you're buying this thing, but you might be surprised on your rates because of past mistakes?
Yeah, the CLUE system, you've got to buy into that and pay a subscription.
Ah.
But on your disclosures, the prior owner's obligated, if I'm not mistaken, to disclose claims, right, that have happened since their ownership tenure.
Yeah.
Yeah. There's also for the larger properties, larger commercial properties, there is what they call an ISO file, which is a shared inspection report where an insurance company has gone in and gone through the entire building. And again, that's a shared file about building construction, fire protection, heating systems, age of systems, that kind of thing. So you'd be surprised at the amount of information available to underwriters to make that final decision. Just a couple of examples on this deferred maintenance issue. There's a building owner, Providence area, old mill building, multi-tenant, up to 20 tenants. They didn't have a clear sprinkler report. Well, after 12 declinations from 12 different insurance companies, it was quite clear that until that sprinkler problem was going to be solved, they were not going to be able to buy property insurance. And if they ever were going to go find financing, that was going to happen. They were going to have to invest tens of thousands of dollars to get their sprinkler system up to snuff before they'd be able to finance or even buy property insurance. Another example is on the North Shore, north of Boston. There's 18,000 square foot mixed retail office mix. So the property's old, 1920s, it hasn't been maintained. North Shore of Boston is considered a wind-prone area. Their premium doubled from last year to this year because the underwriter thought that was a declining risk, and first they were non-renewed, but then the next best offer was twice what they paid the year before. So, so those impacts can happen, you know, even after you've purchased the building and owned it for a few years. So with all of these things that are impacting the insurance industry, whether it's weather, underinsurance, deferred maintenance, what are the underwriters thinking? You know, what's their position? These are the decision makers. So obviously, you're an insurance agent. They're gonna, what we're gonna do is get all your information on an application, put the best package possible, put your property in the best possible light, and send that off to a underwriter desk for a decision on rate and a decision on whether the insurance and what kind of coverage they're going to offer. So with increasing weather, where rates are on the rise, if you're not seeing rate increases above 5%, it's your lucky day. Underwriters are trying to figure out not only what's fair and competitive for a rate, but they're starting to think about what kind of rates do we need to get so we don't go out of business. Before Hurricane Ian happened, there were 5 insurance companies in the state of Florida that filed bankruptcy. That was before Ian. And Florida is basically a insurance disaster zone in terms of where rates are headed and the availability of insurance. There are some insurance companies that put a moratorium on writing new business in Florida immediately after Ian, and they're still not open for business. Underwriters becoming more careful. So 5 years ago, we could go to one particular underwriter. He'd basically take anything we would give him. Today, they'll be far more selective, and they'll weed out the ones that are less desirable, the buildings that are older, deferred maintenance. So again, going back to your clients, if you're representing a buyer, take that into consideration that if you're going to be looking for new insurance, the new underwriter is going to expect you to bring that building up to current standards in terms of roofing, plumbing, heating, electric, and alarm systems before you're going to get your best rate. So if you're going to buy a building with deferred maintenance, expect to pay more, but take that into your consideration when you're making an offer. If you're representing a seller, and there's a budget to improve some of these things, but before you sell, you may be able to sell the building at a higher price, coming forward with improvements to one or more systems. The other thing to notice when people are buying insurance is, Rhode Island is, much of Rhode Island is considered a hurricane-prone area. So on policies, you'll see hurricane deductibles, which are higher than the deductible for all other claims, or you'll see windstorm deductibles, which are higher. And those can average 2% of the building value. So let's take an example. Let's say you've got a building, and the replacement cost is $2 million. With a 2% hurricane or 2% named storm deductible, your hurricane deductible becomes $40,000. If you're not prepared with $40,000 set aside in a bank the day after the hurricane, you're looking to go borrow money to make your repairs. And we know that the loan approval process can be weeks. So how do you start repairs until you get your loan approved? And one of the most disadvantageous times to borrow money is when your building is shut down and closed because of a hurricane. And even worse, many policies have a 2% windstorm deductible. So that's for all wind. That can be wind at 25 miles an hour to 40 miles an hour to 60, not hurricane strength. So again, you could potentially have this $40,000 windstorm deductible. Now, when we talk about wind, wind is what they call the proximate cause of the claim. So if the wind causes the tree to fall onto the roof of the building, that's not tree damage, it's wind damage. The tree falls on the building, causes a hole in the roof. All of the damage associated with that one claim, so the roof and all the interior water damage, is all part of that $40,000 deductible. These windstorms are, for anything within 5 miles of the coast, are common. So huge exposure to your buyer if you're buying in a coastal area. And some companies apply those even in Providence. There are other types of attachments to insurance policies that you got to be careful of, and one of them is, they're called sublimits. So let's say you've got this $2 million building. There could be a sublimit on the policy that says if you have an internal water damage, the sublimit is $100,000. So if you have a water damage claim, you don't have $2 million of coverage, you've got $100,000. So the sublimits are that fine print that you've got to be careful of. And then there are sometimes outright exclusions. If you've got an older roof, I've seen commercial policies where the underwriters come out and said, look, we're happy to insure this building for $2 million, but we're going to exclude any roof damage until you repair or replace the roof. Then the last thing to be careful of is for older buildings is we talk about replacement cost coverage. So the insurance company will replace old for new if you have a claim. But then there are some can be changes to commercial policies where they only give you actual cash value coverage, which means they're going to depreciate the claim settlement when it happens. So if it's in that example, if you've got $100,000 worth of damage, but the property is 40 years old, they may only give you 80%. So they're going to give you 80 when your repairs are actually going to cost 100. Steve, you might have questions. I see there's some chat activity, possibly.
Yeah, Paul Toback. What if a windstorm and your neighbor's tree falls onto your property and damages your improvements?
Tree felled by wind is act of God, or what they consider act of God. So if the neighbor's tree falls on your property, Paul, your policy will pay for the claim. The neighbor has no negligence or responsibility for that tree falling on your property. The only way to prevent that is if you're nervous about a tree on the property line and you're nervous about it, you've got to put the neighbor on notice and say, the tree's deteriorated, so it's a threat to my property. Ask him to take it down. He doesn't take it down. You maybe try to put him on notice to make him put him in a position where he would be negligent if it did damage your property.
How does most of us being close to the shore and the prevalence these days of putting solar panels on roofs, a lot of our commercial buildings have cell towers and all sorts of communication stuff on it. Do those things all essentially act as sails? And can all of these attachment to the roofs, deteriorate the building or the insurability of the buildings?
It wouldn't deteriorate the insurability, but you've got to make sure that the policy acknowledges that you've got additional power generating equipment on the roof or attached,
Okay,
and you've got to make an allotment for that. There are some forms that basically say we won't pay for wind damage to solar panels.
got it.
Yeah, you pay extra for it.
And then Paul also is asking if you recommend, if you have a dispute, do you recommend hiring an independent adjuster to be on your side? What's the best way to handle that?
There's a number of independent adjusting firms in Rhode Island who do a really good job. The thing to consider is with an independent adjuster, typically the way they get paid is they get paid a percentage of the proceeds of the claim. So while they bring expertise, insurance expertise, and they put a buffer in between you and the adjuster representing the insurance company, there's a cost to it.
Okay.
So I guess it would depend on the complexity of the claim, severity of the claim. Maybe that decision gets made after you meet the insurance company's adjuster for the first time, get some feel about where the claim's headed, you feel you're going to be treated fairly. I would say in my personal experience, 95% of property claims get settled without disagreement and without hard feelings, or without somebody feeling they've been taken advantage of. Most insurance adjusters, it's a small community in Rhode Island, Southeast Mass. They're licensed professionals. They're there to work with the contractor, make sure the customer gets treated fairly. Their buildings get put back together. It's most of the times when you have a claim go sideways, it's the misinterpretation about what was actually covered by the insurance policy and what the customer thought they should have been covered. They didn't read the fine print, they didn't read the exclusions, they didn't read the penalty clause, or not that they didn't read it, but maybe nobody explained it to them. Other thing to be mindful of is some people who own property get in this mindset that they've got an older roof, that the insurance company is the vehicle on how they're going to get a new roof. It's rather than be proactive and maintain the roof or replace it when needed. Just to give you an example, I had a claim within the last year. It's an older building, older roof. The insurance company actually hired an engineer to examine the damage on the roof and see if it could be validated that it happened during a recent storm. It turns out that the damage to the roof, or the deterioration of the roof, it happened over 20 years. So rather than come in and pay $25,000, $30,000 for this new roof on this large commercial building, they offered a settlement of much less than that, just a couple of $1,000 for a tiny section of the roof that was impacted by that one storm. And then I'll just wrap up with one last quick topic. It has to do with leases. For those of you who are dealing with rental properties, representing landlords is, every rental property has a lease. And in those leases are insurance paragraphs that places some obligations on the tenant. Every lease is different and not standard, but sometimes you can get surprised by what you find in those insurance paragraphs. As I said, the standard for the last 20 years maybe been $1 million worth of insurance. So the landlord says, I want my tenant to have $1 million worth of insurance. But now we're seeing that those numbers creep upwards towards 2 million, 4 million, 5 million and above. Every million that gets added to that $1 million base is going to add costs to your client, to the tenant. Also, there are requirements that say that the tenant must name the landlord as an additional insured. That can add cost. Not a lot, but it does add cost. And then a thing called waiver of subrogation, which means if the tenant has a claim, the tenant is then required to defend the landlord for all damage. So that can be, again, an added expense. So you got to look carefully when you're representing landlords or tenants. Focus in on what that insurance paragraph says. Find out in advance how that's going to affect the new insurance policy, and make sure that paragraph gets shared with the tenant's insurance agent. So that's my thoughts for the day.
I got one more question from Paul. I'll just read it to you. I don't fully understand it. When doing estate planning and changing the title to the property, will the insurance company deny the claim because the new owner is not the insured?
Every change in ownership, whether you're going from individual to LLC, individual to corporation, individual to trust, or if there's a death and it goes from individual to a state of, all of those ownership changes should be closely paid attention to, and the changes should be made the day they happen. Insurance, by not updating the legal owner of a property, give the insurance company the opportunity to deny a claim, particularly if the claim is serious enough. This happens more in liability claims more than property, because the insurance company is only obligated to write a check. If it's a property claim, they're only obligated to write a check to the name on the policy. So if you've changed your property from an individual to a trust, the claim happens, the check's going to get written to the individual, but it's really the trust that should get the money. Now you've got a problem, and you probably need legal help to get that solved. Or you're going to need a banker who's going to be flexible and allow you to cash or deposit the check. So, Paul, great question. Yeah, those changes are critically important to make when they happen. Same goes for mortgage companies. If the mortgage company is not properly listed on the policy, or if a mortgage has been paid off and the mortgage company doesn't come off of the policy, now you've got a check written to the insured and a bank. Now you've got to go to the bank, prove to the bank that the mortgage has been paid, and you need 2 signatures on the check.
Another thing we've seen a lot lately is, especially with like SBA financing, where they require health insurance or life insurance actually for the borrower. Sometimes if there's 2 partners, they require back and forth policies. So it's a lot more than just the property.
Oh, absolutely. Yeah. Exactly. And with life insurance, if you have that can be a real challenge with an older buyer. Life insurance rates are based on age. So with older buyers or buyers who have medical histories that are adverse, it can be an extremely expensive proposition or sometimes hard to work around.
Mike, I've got a question for you. So we had an owner that had a renovated mill property, and it was mostly office uses, but there was a section that was like ideal for a restaurant use. And so we went through the process, we found a tenant, but then come to find out the insurance costs for having a fryolator in a renovated mill building made it so that the numbers didn't make sense for our owners. So is there something that we can do as agents that kind of helps us so that we don't have to get all the way through all of those points and we can kind of stop that prior to?
It's a great question. It's not unusual for underwriters to be extremely concerned when you have higher fire hazard presented by a restaurant and you have habitational occupancy over it, above it, or in the same building. That's a no for many companies. It's not a no for all companies. But with a renovated mill building, you're looking at a limited market anyway. So can you pick that up in advance? I guess the answer would be anytime you have what's a perceived higher hazard, whether it's cooking, welding, body shop, auto body shop, in a mixed use building with habitational, you're going to run into a problem.
I'm going to actually use that as a plug for this organization and for people like Mike. I think you only get that kind of knowledge by educating yourself about these kind of issues. And I think that's one of the goals of RICABOR, is to have these kind of seminars so our members are informed. But everybody can't learn everything. So you got to find somebody that you trust that you can pick up the phone and ask those kind of questions. I'm lucky I got Mike, but that is the point of these calls. We all have to learn about the what ifs. So, that's one of the benefits. All right, anybody else got any questions?
I think we're looking good, Steve.
Yeah,
Thank
great.
you, Mike.
Well, thank you very much, Mike. Christine, if you have any last words of wisdom.
I just want to do a big shout out to Mike, and then also remind everybody that we are looking for sponsorships for these sort of events. We do have the next event coming up on February 8th, which is the state of commercial real estate in Rhode Island. So February 8th, make sure to sign up for that. And yeah, if you need anything, please reach out to Steve or Mike. Thank you.
All right, thank you, everybody. Thank you, Mike.
Thanks, Mike. Great job.